concentration risk is ridiculous. Everybody seems to want to, everybody, meaning big firms, BlackRock and the rest, big, $1 trillion fund managers are saying just buy the Magnificent Seven.
Yeah.
So this is a serious, symptom of the disease here, but how do we break it? And when does it falter? Because so far, obviously it hasn't. It continues to be the safety trade, the concentration risk of Magnificent Seven.
Yeah.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDucTrading founder, Samantha LaDuc. Get 30% off lifetime membership now with the Black Friday deal. Use special promo code at checkout. For more information about Edge, visit www.LaDucTrading.com/edge.
Look, the passive flows in the market continue to support the bigger and bigger names. I mean, it's a structural issue in the market is that, as target dated funds and 401k contributions just go into passive, they go into the big Vanguard S&P 500, it's the money that just goes in passively into these big funds that then just go in and buy the weightings of the S&P 500, the weightings of the NASDAQ. And so more and more money flows into the biggest name. You add to that all the options activity that takes place at the index level that is further supportive of then the biggest names. And then finally, the biggest names have the best balance sheets and buy back stock. So they also are adding a passive flow to this. So it's very difficult to see an environment where the big cap names start to fall, versus anybody else. Now, I think certainly into the end of the year, given the gains have been in big cap, and given these supportive flows, I would imagine that this trade is going to continue to the end of the year where the flows are supportive. There's no reason to sell into year end because you don't want to pay taxes on gains. You'll wait until January. There's also a tremendous amount of January leap call activity in these mega cap names that probably makes it even supportive through the first few weeks of the year. So very hard to see this breakdown imminently. I think ultimately it will break down on a relative basis when we're like through the reset. We're like, past the worst parts of the fear on whatever growth slowdown we have, and the economy starts to look like it's recovering from whatever slowdown it is, supported by some liquidity and a weak dollar. And I think at that point you'll start to see breath broaden out and folks reallocate some out of Apple and the like and into these other names. But
I don't know.
I don't see it. And the other thing too is,
I know we're more tactical, right? Chase, swing, trend, that's my thing, right? But as it and obviously it's so easy, everybody does it. That's why I've tweeted about this and talked about this, where they're at 99th percentile for hedge funds in the Magnificent Seven. But even BlackRock, I mean, look at this. The model says that the iShares, sorry, that was the head of iShares, doesn't matter. They're all in cahoots with the same investment thesis, which is that the overall industry of tech can grow at, to 10 trillion over the next 5 years.
Yep.
So concentrate is profitable, and obviously the big money is doing it. It's very 1999-esque.
Yeah. Look, I think ultimately the way that this has to end, like from a structural point of view, is the government needs to come in and fix the tax regime that is giving the benefit of these offshore tax havens to these cash-rich tech companies that are able to borrow here and buy back stock and pay much lower taxes. So that's one way. Odds of that very low. And two, regulation, right? These companies are earning super normal profits. They're monopolies. There's changing of the guard as far as AI is concerned and what that means for society and the like. And we need it needs to. I mean, I'm more of a libertarian, but look, we need to regulate. Otherwise, this is more of a societal concept, right? But like, the country's going to break apart. I mean, if we don't start paying our bills, and the only place to really get money if you're the government is to figure out a way to grab money from these big cap tech. So whether it's through regulation on AI that forces companies to pay for data to the government or to somebody, or changes in the tax code that forces this. That's how this will ultimately structurally change. But there's no talk about that right now in DC. There's no momentum for that in DC. So the earliest we're talking about this is, post some new government that gets elected in 2024, and it's an agenda in by the end of 2025, right? So it is very hard to see, how this breaks down. Now, another place we could get regulation, right? We could get regulation sooner in zero data expiry option activity. We could force higher margin requirements. We could force, or transaction, raise the fees or something like that, just to kind of slow down this passive component. Again, not really being suggested right now, but those are the types of things I would like to see to feel more comfortable that a rotation was gonna actually take place. And
no, I'm definitely not recommending, that clients just, concentrate like the rest. I'm looking at this as what are some of the risk factors that would come and topple this over, create some of this durable reversal of this trend.
The full episode is available to all Edge paid subscribers. Visit www.LaDucTrading.com/edge for more information.